Quando o assunto é valuation, é impossível não falar de AÇÜES DAMODARAN. Ele é professor da Universidade de Nova York e uma referência no assunto. Ele está aqui no Brasil para participar da 11ª conferência de CFA e tirou um tempinho para conversar com a gente aqui do INFOMONEY. Professor, thank you so much for your time.
Oh, you're welcome.
I'm going to start with a very simple question, but I think the answer is a little bit complex.
Okay.
You usually say that valuation is simple, but we make it complex. Why is that?
Because we're human beings. The things that bother us in valuation are not something you can fix in a valuation. They're real life problems. I'll give you an example. Uncertainty is not exactly something that human beings like. So when we face uncertainty, we either go into denial, where we say there's no uncertainty, we don't look at it, or we outsource it. We ask somebody else to make decisions for us. And in valuation, we often see the same scenarios. When faced with uncertainty, you either stop doing valuation and say, I can't do it, there's too much uncertainty. There's a pandemic, the country's in risk, this company's too young, and we don't choose not to look at uncertainty. But remember, not looking at uncertainty doesn't make it go away. It's just there, you're not looking at it. The other is you can say there's too much uncertainty, so I'm going to ask Goldman Sachs to tell me what something is worth, as if they have some special insight into uncertainty you don't. So in general, when you look at problems in valuation, it comes from psychological features that we as human beings can't deal with well. And then it plays out as bad choices in valuation.
And now specifically about the stock markets in the USA. This year is a very particular year. The Fed is keeping the rates steady, and there's an election upcoming. How is this fact impacting the valuation of the companies and the stock market in general?
I'm going to surprise you. I don't think the Fed is even part of the story. I mean, let's face it, last year the Fed raised rates 3 times. It was a great year for stocks. The previous year the Fed raised rates 4 times. It was a bad year for stocks. This year the rumor was at the start of the year that they'd cut rates. They haven't done it. It's been a great year for stocks. What does that tell me? Markets are going to go up or down. The Fed is an onlooker. It's a follower. It's not a leader. And I think we need less about Fed and more about fundamentals. I mean, what's driving markets upwards are 2 things. One is that the economy is stronger than people expected it to be. The other is inflation has come down, but perhaps not to the level we thought it would. Those 2 are driving the market. And I think much of what happens over the rest of the year will be driven by those 2 forces. Will the economy stay strong? Will inflation drop below 3%? Because the answers to those questions will determine what happens. Frankly, I couldn't care less whether the Fed cuts rates, raises rates, does nothing to rates, because the Fed really doesn't set any rates that investors care about. The only rate the Fed or any central bank sets in the US is the Fed funds rate, which is an overnight borrowing rate for banks. I mean, as an investor, I couldn't care less what the Fed funds rate is. Not like I can go borrow money from the central bank. I care more about market-set interest rates, and markets are minds of their own.
And what about the elections?
I think it does add a layer of uncertainty. The thing, I mean, one of the signs that an economy is maturing is when elections matter less than they used to, right? I think in the US, elections used to not matter at all because one president came in, there was significant continuity in policy because both sides governed from the middle. And over the last 10 years, I do think we are seeing the growth of a political effect in US markets, partly because the 2 sides have become more divergent in tax policy, on fiscal policy, on business policy. So I do think this election will matter, and I think the closer we get to the election, the more you're going to see it play out, not maybe across the entire market, but across sectors. So if it looks like, you know, Biden is going to lose, infrastructure companies will probably take a hit because a big part of the Biden agenda was supplying the capital to infrastructure companies, you know, green energy companies. So you're going to see sectors kind of, so rather than watch the polls, I would watch what happens to the stock price of those companies. My guess is you'll get a better indication of who's going to win the election by looking at the sectors that will benefit or lose from whoever wins the election.
And how do you see the surge in the tech companies such as NVIDIA? Do you think that, is it possible for them to deliver the market value that's been attributed to them in the future?
See, this isn't something that 2024 brought, right? For the last 2 decades, we've lived off the tech companies. I mean, I'll give you an example. Over the last decade, the FANGAM stocks, Facebook, Amazon, Netflix, Google, Google, Apple, and Microsoft accounted for 20% of the increase of market cap of all US equities in that decade. 6 companies accounted for 20% increase in market cap of 6,500 companies. If you took those 6 companies out, the US would have had a very mediocre decade of stock returns. So when you see this over a period, the question you got to ask is the names might change. This year it's NVIDIA, but I'll wager next year some other tech company is going to come in. This is not a company phenomenon. It's a reflection of a shift in the economy from manufacturing to technology. And technology brings with it a characteristic that creates these big winners. Technology creates more winner-take-all businesses. You take online advertising, right? Before online advertising and traditional advertising, the business was splintered. The largest advertising company in the world might have been the New York Times, but it had a 4% market share because it dominated locally in New York, but in some other part of the country, something else dominated. When you create a technology version of advertising, it's Facebook and Google, you create these network benefits where people want to be where everybody is. So you end up with 2 or 3 companies dominating the business. And I think that phenomenon then plays out as the big winners will be really big winners, $3 trillion companies. So I don't think this is an NVIDIA phenomenon or a Facebook phenomenon. It just is a shifting of the guard from a 20th century economy to a 21st century economy. In the US, you felt it the most because that's where you see the hub of tech companies kind of growing. But I think that's something you're going to see play out in other markets as well, is more winner-take-all businesses because business itself is changing.
And in this moment that we're living, shifting from the manufacturing to the tech, as you said, where Tesla stands, because it's a car manufacturer, but it's also a tech company.
In the good years, Tesla gets viewed as a tech company. When things get bad, it gets viewed as a manufacturing company. Right now, it's in its manufacturing company phase. You can see what happens to the stock price. The more talk there is about FSD and automated driving and how you're going to see the price rise again. So Tesla is in that cusp of technology and manufacturing. Same thing with NVIDIA. The chip business is a pretty boring business, but NVIDIA is kind of revolutionized that, but on 2 dimensions. One is NVIDIA does not make its own chips. It designs chips. It's a designer. TSMC, Taiwan Semiconductors, makes all its chips. So it's more like a technology company in that sense. Its skill set is designing high-end chips and bundling them with software that makes them better and more efficient. So it's not an Intel. Intel I'll measure by, what are your costs? TSMC, how much does it cost you to make chips? NVIDIA is a different beast. It's more technology than manufacturing, and that partly explains the $2 trillion market cap.
You are known to be practicing what you preach. You put your skin in the game. That's what usually is said. What are you looking for now? What are the companies that are interesting you?
I don't go looking for companies because I don't have that much additional cash. I mean, it's different. If I were a portfolio manager and this were my life, I'd spend more time searching for companies because as client money comes in, I've got to find new companies. I tend to kind of take them as they come. So for me, NVIDIA showed up in 2018 on my radar because its stock price had dropped after an earnings report. And I said, this company looks interesting, let me value it. And I found it undervalued then, and I got lucky enough to buy it. So all too often, the companies that show up in my radar are either companies that I am familiar with already, companies I've tracked for a long time. In the case of Brazil, I value Petrobras and Vale and Natura and Embraer frequently because they've been in my portfolio or they're in my portfolio. So it's not as if they're always on my radar because they've been on my radar. But sometimes companies show up accidentally, a company that comes out of nowhere and I'm just interested. Uber for the first time, I said, well, how does a company I've never heard of have a $17 billion pricing? So the advantage I have is I don't have to invest, so I don't have to go looking for companies. And if I find something interesting, then I will invest in it, but then I move on. I'm a dabbler. My interest keeps shifting. So to me, valuing companies from my portfolio is part of what I do, but I'm also interested in issues that I think lie across businesses. Why do businesses behave the way they do? So I have a much easier life than a portfolio manager who has to find companies. I just need to find 1 or 2 or 3 interesting companies each year to buy, and they can be funded with what I sell. So I'm not constantly on the search of I have to find a company that interests me.
You talked about some Brazilian companies. Are they still interesting for you?
I own 2 of them still. I've owned Petrobras and Vale since the dark days. Right? Petrobras I bought in 2015 maybe, and Vale I bought and sold over time. And they're there because I need commodity exposure, I need country exposure, and these companies allow me to get both Brazil and commodities into my portfolio. Because the essence of a diversified portfolio is you need to be exposed to the entire world, not just to the US, not just to developed markets. So I'm looking for companies that are not on my US market radar because I need that to fill out my portfolio. So one of the advantages I've had, because I travel and I teach and I value companies in different parts of the world when I teach there, is I have a Turkish company called AÇØES in my portfolio, and it's a company that I'd never heard of until I showed up in Turkey a couple of years ago. I valued the company. I said, this is interesting. It's a construction company that managed to take advantage of the European sanctions after the Russian invasion of Ukraine. AÇØES stepped into the breach and has huge growth in Russia and Eastern Europe. And that growth is going to stay because European companies are not coming back. It's an incredibly well-run company, and I added the company to my portfolio. But to me, because I travel, this happens in the course. In a sense, it's part of how I approach life. I don't compartmentalize. This is what I'm doing for investing. This is what I'm doing for teaching. This is what I do for my writing ends up becoming part of my teaching, which becomes part of how I invest. So we have only a certain amount of time in a day, and if you can get things to do multiple things for you, I think you get a better chance of getting them all done in a reasonable time.
You talked about Petrobras, which is a company that has been influenced by the government in Brazil, and that always brings issues about, is that impacting the valuation of the company? Does that concern you?
Of course, right? There was a time that Petrobras almost destroyed itself trying to keep Brasilia happy, which is trying to become the largest oil company in the world. I wrote about it in 2014 as an example of a company that almost inverted every first principle and did the exact opposite, right? And that was in 2014, which I called the absolute bottom. And for me, things have changed for the better at Petrobras. It's not like the government has gone away, but they've learned, I think, hopefully, they've learned the lesson of not trying to drive the company towards a political endgame, because then you're going to get economic consequences. The management has shifted, so I think there's a better recognition of their limits as a company, what you can or cannot do as an oil company. So I'm glad, I have 3 oil companies in my portfolio. One is Petrobras, one is ExxonMobil, and one is a company called Lukoil, which I've had to write off. That was my Russian oil company, a really well-run company, but after the Russian invasion of Ukraine, when they essentially put sanctions, I had to buy the ADR listed in London because you couldn't buy the Russian stock. They effectively wiped out the value of all those ADRs. So that's one of I'm not getting that money back. That's, unless I go to Russia and try to get my money back, which I'm not doing. So, Petrobras stays in my portfolio because I think at this point it's as good an oil play as any other. Again, it gets me some Brazil exposure, it gets me some oil exposure, and I'm okay with it in my portfolio.
And just to wrap up, the AI, how do you think that is being counted for in the valuation of the companies? Do you think that's priced already? Or?
Let's face it, 95% of companies, AI will either have no effect or a negative effect. For most companies, AI is not an issue, right? So if you take JBS, they say, what will AI do? What can AI do for a meat processing company, right? If you take a retail company, what will AI do? Not much, because you can maybe reduce costs, but everybody can do it. There's a very small subset of companies that actually are either very positively or very negatively affected by AI. Right now, there's only one company which has any real substantial numbers it can point to. That's coming from AI, and that's NVIDIA, because it makes the chips. I can't think of a single other company where I can point to the revenue and say that company's revenues are higher because of AI. There's the promise, Microsoft, Adobe, and the price is reflected, but it's still not showing up in revenues and earnings. In those companies, I will build in that expectation. Markets are obviously doing it. Are they overdoing it? Probably. But for most companies, AI is a side story, right? It's not something that affects the value. It's a distraction more than a driver of value.
And how do you see the technical analysis? Can it be an ally to the fundamentals?
Well, I think it's, you can either be an investor or a trader. When you enter markets, you've got to decide what game you came to play. In the investing game, what you try to do is find companies that are undervalued. You buy the companies at a low price, and you hope the price converges on value. That's the investing game. And often when you take classes, that's what's emphasized. But there's a different game, a game that most people play, which is the trading game. How do you make money in the trading game? You buy at a low price, you sell at a high price. Why? It doesn't matter why the price went down. So the tools you use should reflect what you came to play. For the investing game, you need a tool to value companies. Discounted cash flow valuation, intrinsic valuation. In the trading game, you need tools that tell you when mood and momentum are shifting, because that's how you make money as a trader. You know what? Technical analysis is all about detecting shifts in mood and momentum. You take charting. Every single charting indicator is basically, at least in theory when they sell it, giving you a signal. Support lines, resistance lines, why do they matter? Because they might signal a shift in mood and momentum. So as a trader, I think it makes complete sense. In fact, I think if you're a trader, it makes far more sense to look at charts and technical indicators than to do a discounted cash flow valuation. So I don't use it because I'm not a trader, but I'm not going to wag my finger at people who use it who are traders, because I think it fits what they do.
And valuation, is it a science or is it an art?
It's a craft, right? It's neither. It's not a science, because science, you get the inputs right, you get the output right. I've never valued a company, even if I've spent hours on the inputs and I think I've got them right, I know my valuation is always going to be wrong. Why? Because the future is uncertain. So it's never a science. So valuation is not a science. So adding more rules, creating more models is not going to give you a more precise valuation, because uncertainty remains. It's not an art, because an art basically means I can do whatever I want. That's the essence of an art. If it looks pretty, then it's okay. Valuation, you can't do whatever you want, because businesses are bound by the laws of economics, right? So a craft basically means you recognize there are laws of economics, that you live in a world where other people are trying to do what you're doing, and you try to tell a story about a company that you convert into numbers. And it's a craft because the first time you do it, you're not going to be very good at it. Why? Because you've never done it before. But the more you do it, the better you will become. But if you do the same kinds of companies over and over, it's like learning to cook pasta. You cook more, then you get really good at pasta. But then if I ask you, can you make fried rice, or can you make a souffle? You say, I've never done it. So if you want to get good at valuation, not only do you need to value a lot of companies, you need to try your hand at different kinds of companies, because each time you value a company, you will learn something about the craft, and you will get better at it.
Thank you so much for
You're
your
welcome.
time and for the lessons.
Thank you.